Good morning, sir.
I look forward to that every Monday, Dennis.
I have to do it for the bushwhackers. Tim,
the day is not. It just doesn't get off to a good start unless you're doing that. So
it's really dark outside where you are, so we can't tell where you are right now. I'm assuming you're in the mountains.
I am in Steamboat. Yep, Steamboat Springs, and I'll tell you, it was just spectacular yesterday. So that direction is Mount Werner, which is about 10,600 feet, and it was snow covered and a little crown of clouds around it, and yet about halfway down the mountain, the aspens are still orange and yellow and red. It was just, I mean, I get to be here all the time, and I'm still just stunned by how beautiful it is. So that's awesome. Where I am. Yeah. I see you've got Jay Powell with you today.
Yeah, we have a special guest on the show here, and we were asking him
just for today.
Just for today. It's good thing you're talking about buy now, pay later, then, because that is the Fed's mantra.
That's true too.
Right? Don't worry about the cost, just spend. Spend.
Mm-hmm. What we've had a long discussion here. We've been talking inflation. We've been talking obviously a lot of things that are out of our control with the supply chain. We've been talking about labor shortages. We haven't been talking that nice about technology stocks here really this morning, because the one thing is when you have higher inflationary environment, high growth tech doesn't do as well. And we've seen that if you can look at Kathy Woods, who is a great indicator for high growth tech. It's actually not too far off of its 52-week low. And then you have commodities that are just blasting off, oil making new highs, looking like it wants to go to $100 a barrel. But sometimes you get the Tim on here and he can break down and look into the market structure and look and see what's under the hood. And that's what we want to do with you today here, Tim, is what's under the hood here. First, let's just talk technology stocks in general. Okay.
Well, and the point from a trading perspective for folks who use Edge, marketstructureedge.com, the whole point is we want to follow the money. Who cares, really, ultimately, where that money is going? I mean, I think it's part of it being a well-informed citizen of the Republic to understand how some of these things work. But ultimately, what we want to do as traders is not confuse busy with productive. A great line that I got from an Israeli finance executive who told me, Tim, we try not to confuse busy with productive. And I thought, that's a useful line. I'm going to make use of that. And it's very easy to get caught up in that, traders, where you think, well, surely tech has got to do well. And then it's not doing well. You see energy doing well. We want to follow the money and take advantage of the swells that it creates in the market and then leave before the wave disappears. So how do we think about this from the standpoint of an inflationary environment? Keep in mind that inflation is nothing more than your money doesn't go as far as it used to. That's the way to think about it. Spencer and I talked. I think I was driving Spencer crazy with this, right, Spencer? I think it was on Thursday. Was it Thursday or Friday? I can't remember. It was.
The days are all one to me, too.
I know. It's the same to me. But I like, this is my point, and we'll talk about energy, because really that's where the money has been. And we talked about it last Monday. I said, if you look across the dashboard at Edge, clearly the best thing is energy. I bought AMR and GM and Nokia. All of those did 6 to 8 times better than the broad market. I bought and sold them all last week. Again, just going where the money is. We talked about GM. I was wrong on one account. It did not become a meme stock, but I was right that it would go up 6 or 7%, which it did. And so we'll talk about where that money is going. Here's the thing to understand, everybody. You want to clear a room, start talking about economics or monetary policy or even market structure. But this is the concept. It takes people and money to make stuff and to provide services. So if we want a lot of that occurring, then we have to have a stable currency. So money has to be worth something predictable, and wages have to be predictable. If the government intervenes and says, here, we'll give you a check, then labor becomes more scarce. There isn't enough of it. And if the Federal Reserve increases the supply of money, it takes more of it to make stuff. So those are the two things that undermine growth. If you discourage people from working and you create more money, it has the opposite effect of what the government is telling us it should have. Well, that's not the stuff we want. Prosperity always comes from knowing what the value of money is so that business can get more efficient and the cost of things can go down. That's what tech has traditionally done. An iPhone goes from costing a fortune to being approachable by everybody. How does that happen? Well, productivity improves. The distribution, the production of goods gets more efficient, and that gets very difficult in the current environment. And that's why tech is struggling. So we want to think about this, traders, and you don't even have to think very hard about it. All you have to do really is look at the supply and demand of money. And if the supply of money to the FANGs is diminishing, don't buy the FANGs. Where is the money increasing? Energy and financials. Why is it increasing? I don't even care that much about it. From a trading perspective, all you need to worry about is where the money goes. Sure, I can tell you why. If interest rates go up, financials are going to perform better. If there are more dollars in circulation, the cost of energy is going to increase. And cotton's at a 10-year high. Look at copper. As you said, Dennis, look at all the commodities. Why are they more expensive? Because the denominator, money, keeps shrinking. Because we're creating more money than with the output that is supposed to support it. That's why this is all occurring. So if we wanted a beautiful, prosperous economy, we would want money that had stable value. It's not more complicated than that. But that we don't have that, so we have to adapt to it, right? That's how it is.
So, broadly speaking, where is the sentiment right now at this point? Because I mentioned at the top of the show, we do have earnings seasons kind of starting this week with the bank, speaking of the financials, and then more so next week. So
Right. Let's look at it. You know, I love to do that. And traders, this is to me what makes Edge very simple. MarketStructureEdge.com. You can try it for free. It's a way to just take 2 weeks and think about supply and demand. If it's not right for you, don't worry. We don't care. We don't require any commitment from you. You can just try it. So here's how we think about this. The money ebbs and flows. And it does so in measurable ways because of market structure, which Dennis is an expert in. That's the rules that govern how trading works. When I did the demo on Thursday, I used my own Interactive Brokers account, and I showed everybody how my stuff is trading. Where's it going? And how come it gets all, most people don't realize it's all fragmented. There isn't a lot of supply in the market actually, but that makes it measurable. We can see supply and demand. So suppose that the market had a supply demand scale of 10. So the closer to 10 you are, the better from the standpoint of excess demand. Well, here's the broad market right now, Spencer. It's 5.1. It's almost dead even. And if we looked at that pattern over time, what we're showing here is SPY, the State Street ETF that tracks the S&P 500, and the underlying waxing and waning, ebbing and flow of demand for SPY and the stocks that comprise the S&P 500. That's it. I mean, SPY is really a derivative. It trades in place of the 500 stocks in the S&P 500, so you don't have to own them all. But notice this: when demand hits a peak and begins to decline, leave. You may not be exactly at the top, but you're going to know. When demand bottoms and begins to rise, I had a great week trading last week. Then you can return, but return to the things that have excess demand. I'm telling you, it's not more complicated than that. So let's look at our own portfolio.
Hey, Tim, just going back to that chart right there. Yeah. Could you go back to that chart right there?
Absolutely. Let me back it. Yeah, there you go.
I mean, isn't that? I mean, if you're looking at like the price and then the levels of demand it reaches, doesn't that look like you're getting lower highs in the chart and then lower highs in demand? So wouldn't that give you isn't that a very bearish looking chart?
Yes, it is, Joel. Yes, that is a very astute observation. And if you go back, let's just go year to date. We started the year with a very strong momentum market because look at the peaks. This is like the backbone of the continent, the Rocky Mountains. We've got staggering peaks. Well, now the mountains are old. It looks like Vermont. I mean, they're just right. They're just deteriorating. And you're absolutely right. That's why I think we are at great risk. We have been in accelerating risk since April of a significant pullback. I've used this line before. So if and it's not because my mental faculties are deteriorating wholly, they are deteriorating. But it's a great line. It's a line from The Sun Also Rises, Ernest Hemingway book. And the two characters are talking and one says to the other, well, how'd you go broke? And he says, slowly, then all at once. And that it's how the market falls apart. It does not fall apart all at once and you go, Shazam, what happened? No, it started to deteriorate here. Traders, there are plenty of opportunities to trade. You just have to look where the money is going. If the money stops going to the whole market, is it going to tech? Is it going to consumer discretionary? Is it going to large caps? Is it going to small caps? All of that is measurable. And you just want to put yourself where it is. I only trade 30% of the days. The market has 252 trading days in a typical year. So 30% of the time I'm trading stuff. And I crush the broad market by following demand. But you're absolutely right. Joel, you'd look at this pattern and say, well, those peaks are getting weaker and weaker and weaker. Well, that's a sign for us traders. You should not have all of your money exposed to a market where the demand is beginning to weaken. Now you got to be very selective. And we have options expiring starting Thursday. Thursday will be index options expirations, Friday, triple witch. Then Monday, a new series. The new series in a weakening market, it tends to be when the new series trades that the trouble occurs. And we've been having that happen repeatedly. Happened here, happened here, happened here, happened here, happened here. Is it going to happen again? Well, I can't tell you, but the math would tell us, well, I should be pretty cautious around Monday the 18th. And you can't peg the day. It's so massive. The market is so massive, you cannot predict the day that something will happen. But you could look at this and say the supply-demand equation, Joel, you're exactly right, is deteriorating. You're exactly right. Yep. So
Tim Quast says
let's go look at one thing before you do that, Spencer, because I want to talk about a firm. Let's talk about a firm. And then look, here's the supply-demand balance in this portfolio. You can see that demand is well above 5, but flattening in whatever the 10 components of this Benzinga October 11 portfolio are. Energy is the lead sector. Fast trading machines that just want to fool you are the top behavior. Short volume, the supply side, the trend is up. The last few days are down. So that's not horrible, but there's something in there that's helping us. So let's go look at it really quickly. And so if I look at, who's at the bottom? Palantir. Palantir is a 1 and bottomed and 42% short, and the short trend is up. That was the closing price. It trades $5,500 at a time. Market cap's $44 billion. Key behavior, passive money leaving, and it's in the tech sector. Well, what's the best? Well, look at the ones at the top. It's all AMR stock I like to trade. 10 out of 10, 32% short. Look, Diamondback, Marathon, Devon, Hess. All these stocks were up 10 to 11% last week. You want to go where there's excess demand. Now you'd say, well, they're all topped. Yeah. And I think when those deteriorate, get out. But it could give us another 2, 3, 4 days of gains in energy.
How do you know, Tim, when to get out? I mean, you come in and you can buy the 10 because that's the strongest stuff you'd be going into. But how do you know, when it's time to ring the register?
Right. Key, right? Entries and exits. All trading boils down to entries and exits. So by rising demand, I bought GM on Monday when I said, well, it looks pretty good. So when sentiment began to deteriorate and short volume jumped above trend, I left. You could still get some additional gains, but I'm happy with my 6 or 7% gain there, and I leave. But it's falling demand. Buy rising demand, sell falling demand. It's just like surfing a wave. When the wave begins to deteriorate, your ride is over. And it's that simple. And it's not perfect. It's not perfect math. It's just better than all the other math. And that's all you need. So that's it. Buy rising demand, sell falling demand. Be very aware of options expirations and month ends because all the chairs shift 1 or 2 to the left or to the right. And you have to realize it's going to distort the wave. But that's how you do it. And you repeat that over and over. You don't have to own 50 things. I rarely own more than 4 or 5 things at a time because I'm not smart enough to watch more than that. But that's all you really need to do, traders. It's fairly simple.
All right, Tim Quast joins us every Monday from Market Structure Mondays. He is the founder and CEO of Market Structure Edge, marketstructureedge.com. Tim, always a pleasure. We'll talk to you again next week.
Good to see you, my friends. Have
Thanks,
a good
Tim.
week.
All right.